Hi everyone. Today I will give you a brief idea of financial statement, definition, type, and an example that show you how we can calculate different financial statements. The topic includes a brief overview of financial statement, then what is the need of finding out it, and lastly different categories of financial statement with a detailed discussion. Here we will talk about two type of financial statements in detail. The first one is income statement and the second one is balance sheet. In our next slide, we will or in our next session, we will talk the rest of them. So financial statements are the reports that provide the details of the entity's financial information, including asset, liabilities, equities, income, and expenses, shareholders' contribution, cash flow, and other related information. These statements normally requires annual audit by independent auditor, and they have presented along with other information in entity annual report. They are presented in two comparison periods so users could understand how is the current period's financial performance compared to the corresponding period. There are five types of financial statements that entity requires to prepare and present. If those statements are prepared by using IFRS, those five type of financial statements including income statement, statement of financial position, statement of change in equity, statements of cash flow, and the noted to financial statement. Next, we will talk about what is the need of financial statement. The first one, investors and financial analysts rely on financial data to analyze the performance of a company and make prediction about its future direction of the company's stock price. One of the most important resources of reliable and audited financial data is the annual report, which contains the firm's financial statement. Second one, the financial statements are used by investor, analyst, and creditor to evaluate a company's financial health and earning potential. The three major financial statements report are the balance sheet, income statement, and statement of cash flow. Third one, financial statements are written records that convey the business activities and the financial performance of a company. Fourth one, the balance sheet provides an overview of asset, liability, and stockholders' equity as a snapshot in time. Fifth one, the income statement primarily focus on a company's revenue and expenses during a particular period. Once expenses are subtracted from revenue, the statement produces a company's profit figure called net income. And lastly, the cash flow statement measure how well a company generates cash to pay its debt obligation, fund its operating expense, and fund investment. Here we are talking about first type of income statement, that is first type of financial statement, that is income statement. The income statement is one of the financial statement of an entity that reports three main financial information of an entity for a specific period of time. Those information included revenue, expenses, and profit or loss for the time period. Income statement is sometimes called the statement of financial performance because this statement lets the user assess and measure the financial performance of an entity from period to period of the same entity or with competitors. The first format is a single statement format where both income statement and other comprehensive statements are present in one statement. The second format is the multi-statement where income statements and other comprehensive income are present in two different formats. In conclusion, if the users want to see how much the entity make shell, how much are the expenses incurred and how much is the profit or loss during the period, then income statement is the statement that the user should be looking for. There are certain the formula which is used for calculation of income statement, which is net income equals to total all revenue for the period, which is subtracted from total all expenses and cost of the operating of the business. Now we talk about revenue. What is revenue? Revenue refers to sales of goods or services that the entity generates during the specific accounting period. The revenues that present in the income statements are the revenues from both cash sales and credit sales. In the revenue section, you could know how much the entity makes net sales for the period they are covering. You may see the different lines of revenues that the entity is generating for the period. This could help users to understand which line of the revenues are significant, increase or decline. In double entry accounting, revenues are increasing on credit and decreasing in debit. There are certain types of revenue which includes operating revenue. It is the revenue earned by selling a company's product or service. The operating revenue for an auto manufacturer would be analyzed through the production and sales of autos. Operating revenue is generated from the core business activity of a business. Then non-operating revenue, it is the income earned from non-core business activity. These revenues fall outside the primary function of the business. Some non-operating revenue examples include interest earned on cash in the bank, rental income from a property, income from strategic partnership like royalty payment receipts, income from an advertisement display located on the company's property. Other income is the revenue earned from other activities. Other income could include gains from the sale of long-term assets such as land, vehicles, or subsidies. Now, the term define expenses. Expenses are operational costs that occur in the companies for a specific accounting period. Expenses are recording in a different direction from revenues in terms of accounting entry. They are increasing in debit and increasing credit. There are certain types of expenses. First one, primary expenses, which are incurred during the process of earning revenue from the primary activity of the business. Expenses include the cost of goods sold, selling, general and administrative expenses, depreciation or amortization, and research and development. Typical expenses include employees' wages, sales commissions, and utilities such as electricity and transportation. Secondary expenses that are linked to the secondary activities include interest paid on loan or debt. Losses from the sales of an asset are also recorded as expenses. The main purpose of income statement is to convey detail of profitability and the financial results of business activities. However, it can be very effective in showing whether sales or revenue is increasing when compared over multiple periods. Investor can also see how well a company's management is controlling expenses to determine whether a company's effort in reducing the cost of sales might boost profit over time. Then, profit or loss. Profit or loss refers to net income or the bottom line of the income statement that results from deducting expenses from revenue. If the revenue during the period are higher than expenses, then there is a profit. However, if the expenses are higher than revenue, then there will be losses. Profit or loss for the period will forward to retain profit or loss in the balance sheet and statement of change in equity. An example of income statement is given to you in the PDF form, which is also sent to you. Please see the Google Classroom material section. Now we talk about the second part of financial or second element of financial statement, that is balance sheet. Balance sheet is sometimes called the statement of financial position. It shows the balance of asset, liabilities and equity at the end of the period of time. The balance sheet is sometimes called the statement of financial position since it shows the value of the net worth of the entity. You can find entity net worth by removing liabilities from total assets. It is different from the income statement since the balance sheet reports accounts balance at the reporting date while income statement reports that the accounts transactions during the reporting period. If the user of financial statements wants to know the entity's financial positions, then the balance sheet is the statement the user should looking for. There is certain formula which is used for balance sheet. The formula is asset equals to liability plus owner's equity. The balance sheet total will be calculated already, but here how you identify them? The items which will be identified, the first one is asset. Assets are resources owned by an entity's legal and economically. For example, building, land, car, and money are the types of asset of the entity. Assets are classified into two main categories, current asset and non-current asset. Current asset refers to short-term asset including cash or hand, petty cash, raw materials, work in progress, finished good, prepayment, and a similar kind that convert and consume within 12 months from the reporting date. Non-current asset that expected to convert and consume in more than 12 months from the reporting date. Those assets includes land, building, machinery, computer equipment, long-term investment and similar kinds of. Non-current asset or fixed asset is again divided by including by tangible and intangible asset. Intangible asset or intangible fixed assets are charged into income statement systematically based on their using and contribution. In the accounting equation, assets equals to liability plus equity. There are increasing on date and decreasing credit. Then we talk about liability. Liabilities are the obligation that an entity owes to other person of entities. For example, credit purchase, bank loan, interest payables, um, tax payables, and an overdraft. The same as asset. Liabilities are classified into two types, current liabilities and non-current liabilities. The liabilities are the balance sheet item and they represents the amount at the end of the accounting period. A current liability is an obligation that is due within 1 year. In other words, the entry is expected to pay or willing to pay back the debt with 1 year. For example, purchase on credit within 1 month should be recorded as a current liability. Non-current liability are the debt or obligation that due to more than 1 year or more than 12 months. For example, long-term lease that due in more than 12 months should record in the non-current liability.